Today's topics, right, I will just cover why the market keeps going up, because as you know, market get into like all-time high for consecutive few days already. I think probably more than 1 week already. If you see the markets every day, record high, record high, record high. The question is like why, right? I try to address this. And the material, right, that I'm going to use is not the material that I created myself. This is actually from JP Morgan Asset Management. So every quarter, right, they will release these guides. I'll put the link at the description. So there are the US portions and then there's Asia portions. There are two slides. Some of the material actually overlap. I like this deck because when they present all these informations, right, most of them is in the form of charts, tables. So it's quite easy to digest. There's a lot of information here. I will not cover all of them. I will just select a few slides, and I think these slides are quite important and quite useful for us to understand the situations, the broad market economy. And all these updates is as of end of June. So I think it's still quite recent and quite new. It's very useful. So let's just take a look. When I say market all-time high, I'm referring to S&P 500 because I mainly cover US and Western market. Later, there will be a couple, one or two slides that cover about other markets, for example, like China, but those are not the key focus of the presentations. So if you look at S&P 500, right, it goes zigzag up and down, right? But when zigzagging, sometimes you can refer to like 1 year, within one particular calendar year, it can go up or down, right? And let's say if you just zoom out, right, you look at the broad market, sometimes the market it can rally for a couple of years, right? That's why you see market can go up quite a fair bit within, let's say, a number of years, right? So let's say if we start from year 2000, right, market crash 49%, then after that it go up 101%. You know, market just double. But this double is not in like 1 year because it doubled from 2003 to 2007. It doubles, right? Then market have a huge crash down by 57%. Then after that it outperforms like up 401%. But this one also take a bit of time from 2009 to 2020. That's like 11 years of bull market, right? Then down 34%, up 114%, down 25%, up 73%. If you come from the low of end of 2022, market is already up 73%. Quite a huge jump. Consider that now we are at 2025, right? So it is only like less than 3 years, market is already up 73%. But of course, for those who still remember during the Trump tariff case, I think market dropped by like 19%. So now we are back to all-time high again, right? So market can be very volatile, but over the long term, you can see that every time they have a drawdown, right, the recovery, the rally seems to be higher than how much is the drawdown. That's why market drift upward over time. Then the second chart I want to show here is the forward PE. So this is just a gauge on the market valuations. If you look at forward PE, don't say that a forward PE high means market is overvalued. It's not the case, because what forward PE measure is just the market price divided by the expected earnings over the next 1 year. And sometimes all these higher expected earnings over the next 1 year is justified one, because market could be, or entire economy or the market can be showing a lot of promising trends, right? Say for example, let's say some regulatory changes can be pro-growth kind of measures. That's why all these forward PE, sometimes when it is high, it's justified. If it is justified, then it doesn't mean it is overvalued. But at least over the long period of time, you can look at this forward PE, it goes up and down, right? When the forward PE is high, you can just claim that forward PE is high. It doesn't 100% sure that market is overvalued. But it does seem overvalued, right? When you look at current forward PE is at 22. The last time it was this high was around end of 2023, and then of course during Trump tariff it dropped by 20%, right? Then the period before that it will be around 2021, and of course 2022 there's a huge drawdown after Federal Reserve increased the interest rates, right? So of course high forward PE doesn't mean that market would drop. It just means that market valuation is high. Let's say if there's anything wrong, right? Let's say like the interest rate is getting too high, or let's say some fiscal policies or some Trump tariffs or any other things, right? Could be war, could be anything, right? When there's any trigger, this kind of trigger happen when the market is like kind of like highly valued, so the drawdown could be a lot higher, right? That's why I'll say when the forward PE is high, usually try to be careful, try to be more reasonable in your expectations. I think that is encouraged. Don't say that it is 22, then I should sell all my stock portfolio and then move to cash. I think that is really not a good move. Okay, so just look at it as it is. It is just a forward PE. Okay, then the next chart here, this is a scatter plot. Let me explain this chart because I think for those who are not familiar with scatter plot, right, you might not get what this chart is saying. If you look at the left hand side chart, right, so on the x-axis, right, it is just showing what is the forward PE, and then on the y-axis, right, it is showing what is the subsequent 1 year returns. So let's say if you look at one data point, let's say you go back to 2020, you look at 2020, what is the forward PE? Let's say the forward PE is at, I don't know, just throw some number, right? Let's say it's 20, and then you just look at from that point onwards, right, what is the subsequent 1 year returns, and let's say the return is I don't know, let's say 15%, right? So you just plot that 20%, 20x PE and the 15% returns as one of the dot in this chart. Then you just look at from historical period, how many points do you have, right? And you just plot all these dot on this scatter plot here, and then you just see what is the pattern, right? So if you just look at the left hand side, just look at 1 year returns, right? Of course, you can do a regression to say that, oh, you see here, if the forward PE is high, usually it leads to lower returns because you see the orange line is going down, right? So this is what it's trying to say. But you see there's a R square equals to 5% at the bottom right corner, right? That one is telling you that how reliable is this regression, because as you can see here, the dots, right, it is not like every dot line up in a straight line, right? It's actually quite noisy. It's scattered around. What it means is that actually even if you know what is the forward PE, you can't predict what is the subsequent 1 year return accurately, because the R square is only 5%. If the R square is higher, for say for example like 80 or 90%, right, then as long as you know what is the forward PE, then you basically can predict what is the future 1 year returns. But it is not the case, because 5% is extremely low. It's almost useless, completely useless. But if you look at the right hand side chart, right, this is not showing the 1 year returns. This is showing the 5 year returns. It is the R square is 13%, meaning that the predictability of market returns, 5 year subsequent returns, right, by just looking at one data point, which is the forward PE, it is higher. It's at 13%. So as you can see, they are closer to the line, but still there's plenty of noises there because R square is still 13%. People tend to use this chart to say that if the forward PE is high, that means it's likely that you get a lower returns. People actually make this kind of statement, but I will say that there's some truth in it, because as you run the regression, you get an orange line that is downward sloping. So there's some truth in it. The problem is that the R square is too low, it's almost useless. So there's a lot of caveat when presenting these kind of things. I say, no, see it as what it is. The fact is that the forward PE looks high now. This is the fact. But whether it means the subsequent 1 year returns is low or high, that one's still very hard to say, because there's not much predictability power for using forward PE. So this is quite useful chart to show you. And then the next one will be showing the calendar year returns for S&P 500. As you can see here, right, the gray bar, right, this is the actual returns. So if you just focus on the recent year, right, 2024 we have 23% return, and then the year before that we have 24% return. You see, market has been kind to us at least over the past 2.5 years. But if you look at the dot, the red dot right there, right, the red dot showing the drawdown within the year. So the 19% here that you are seeing here, this is the Trump tariff hoo-ha-ha that we just had, right, in April. So yeah, we have 19% drawdown, but now it's already recovered. But if you just look at US S&P 500, actually the return year to date is only at about 5%, right? It's not fantastic. Actually, other markets has even performed even better as compared to US market. We will look into other markets later. But just to show you this chart, right, on average, US market returns is about like 10%. And if you can see the gray bar, right, actually there's more gray bar as compared to like more gray bar that is positive as compared to negative. Because if you look at the losses, right, yes, 2022 we have like 19% returns in that calendar year, and then before that was I think 20, this is 2020, right, it's 19, 18, 17, 2016 also there's a loss there. Rarely we have a calendar year losses. It is like I think maybe just 1/3. The other 2/3 we end up with positive. But if you just look at the drawdown, every year we have drawdown, and some drawdown, right, let's say like 2020 COVID, right, we have 34% drawdown, and just this year not too long ago we have 19% drawdown. So we always have drawdown one. It's just that after all this drawdown, usually market tends to recover, and then you will have end up with average return of about 10%, at least historically. I'm not saying that in the next 5 years we are getting 10% average. Future return is always hard to predict. So just look at the history and try to study the history here. Then the next one, I think this is quite interesting, because from time to time, all these, JP Morgan, they will come up with some additional slides that they haven't presented before. This one I think is quite useful. The left hand side chart shows the CAPEX from major AI hyperscalers. So they include Alphabet, Amazon, Meta, and Microsoft. Basically, it's the three hyperscalers plus Meta, because I think Meta, they also spend quite a fair bit in all the data centers, right? So if you look at 2024, that's a huge jump in capex to 199 billions. That's why you look at Nvidia numbers also, it's a huge jump in 2024, right? So I think the key point here is that 2025, which is this year, we are still expecting an increase in capex to 278 billions. So that's why this year returns should be okay for Nvidia. At least I'm referring to their revenues. But the subsequent 2 years, right, I think markets, just to summarize this chart, is that JP Morgan is expecting that there will be further growth. It's just that the growth rate will slow down considerably as compared to this year and last year. Basically, when you talk about the capex for all these hyperscalers, what it means is that this is a good indicative of Nvidia revenues. But I just want to tell you that it's very hard to guess one. I think even for JP Morgan, I don't know what kind of research they have done behind the scene, but they are all just guessing. So just take this as their guesses. Maybe wrong one. So just FYI on this. Okay, the next one, because when we talk about like why market hitting all-time high, right, you can't avoid talking about macro. And when we talk about macros, right, usually two important things will be the growth rate, GDP growth. The second thing is we want to talk about Fed fund rates, Federal Reserve policy, or all these things. It will come back to inflation one. So you also need to understand what's the trend of the inflation at this moment, right? Currently, the inflation that US printed, right, is 2.4%. If you just look at 2.4, we know that it has cooled off, right, from around mid of 2022, 9.1% now cool off to 2.4% coming down, which is good to see. But it's also important to look at the breakdown of all this inflation and ask ourselves like what's the components, which one is more sticky and which one is still lingering, and which one is like we already get into deflation instead of inflation, right? So I think this chart is quite useful. As you can see the component, right? The purple color, food at home used to be quite a problematic situations around 2022. Now it already cooled down, and then shelter already cooled down, but still quite a fair bit of those inflations still coming from shelter. But all this shelter, I think there's lag in terms of their data one. So that's why you see it has been coming down and it is projected to continue to slow down in the future. That's why if you look at this 2.4%, I think most likely it will continue to cool off based on this chart, unless something big happening, right? But I think shelter is the one that we can foresee to keep trending down. But which one is already at deflations? One good example is energy. You look at energy around 2022, right? Energy prices were so high. I think that was also because of Russia-Ukraine war. Then now, if you look at the energy prices, it has cooled off, and now it's actually contributing to deflation instead of inflation. So now 2.4%, I think people are saying that US Fed, they should cut rate. No point to keep the Fed fund rate is at about more than 4% when your inflation is 2.4%, right? So I think Federal Reserve, they recognize this. It's just that when it comes to cutting interest rate, they are not so aggressive, because what they are afraid of is that what if they cut rate now, suddenly these inflation prints go back to 3%, right? So should they jack up the rate again? So that's why they try to be more conservative when it comes to cutting rates. But the good thing is that you look at all this trend, right? As long as this trend doesn't revert back up, right, I think we are fine. And actually market is expecting all this inflation to cool off now. So that's inflation. Everyone become macroeconomics expert if you want to understand the broad market, right? I'm not expert here. I'm just trying to cover some of this data, which I think is useful. Like I said here, when we talk about inflations, usually inflation doesn't affect the market directly, but inflation will drive US Fed decisions, and US Fed decisions will affect the markets. So I think the expectation is that Federal Reserve will cut interest rate 2 times second half of this year, from now till December. So if you look at the expectation is that currently we are at 4.38%, because US Fed fund rate, there's a range, right? The range currently is at 4.25% to 4.5. So if you take the midpoint, is at 4.38. So market is expecting this rate to drop to 3.63%. I think this is should be about end of the year. Then further down to about 3%, maybe around next year. I can't see it from the chart here, but if you look at the CME rate, right, a CME table, they will show a clearer path of what is the market expectations. And then of course this is consistent with the FOMC projection, because FOMC projection, this is basically Fed governors, they are making opinions like saying what is the Fed fund level by the end of this year, end of 2026, and long run, right? They are all expecting market to come down. That's why all this has been priced into the market, thinking that okay, as Fed fund rate cool off, coming down, then it's good for stock market. So this is the US Fed. The other thing which I just want to cover, which I think is quite important, which is the federal finances. Because if you look at current situations, right, federal finances is not in a good shape. Because if you look at US US government revenue versus their expenses, right? Of course, they have quite a sizable deficit. And if you look at the total spending, right, it is like huge spending, 7 trillion spending. This is still talking about the budget, right? 7 trillion, but the amount that they collected is like less than 7 trillion. It's only at what 5 point something, right? 5.1 trillions. So definitely not enough to cover. And the net interest that the US government is paying, right, is close to 1 trillion. So I think this is also quite worrying. And if you look at the big beautiful bill that just passed, right, also it's not a good sign that market. So how to say? It's not a good sign, or it doesn't point towards that the US government is willing to do some form of austerity. So when it comes to spending, they still want to spend like crazy. So this is quite worrying. But what's the implications, right? So this is talking about the one big beautiful bill. So this is just signed by President Trump. But the problem now is that if you look at this net interest, right? Net interest is basically the interest that US government need to serve. And they need to serve all this interest because their debt is already ballooned to such a big number. And if this continue, right? Because US government, they don't have money to pay all the debt one. So as all this debt mature, right? They need to issue more US government bond to pay interest and the matured debts. So what it means that the future issuance of all this debt, right, become larger and larger. And when that debt become larger, the interest rate also become larger. So this net interest, right, as a percentage of their total spending will become higher and higher. So that's why I said on one hand, this is quite worrying. On the other hand, the implication is that when this debt become a lot larger, right, actually that what it means is that the money base will also become larger. So what I wanted to say is that this M2, right, if these things continue, right, it will become a lot larger. So as M2 become larger, but there's more people with cash and all this money base become a lot larger, right? What it means is that the inflations also become higher, okay? And when this money base become higher, you look at everything, right? When I say inflations, yes, some people, economists might say inflation means everything's goods, right, become more expensive. I think that's one way to look at that. The other way is that the asset prices also inflated because, for example, let's say if you own a house, right, number of houses doesn't increase exponentially like the M2, right? So if the pace of the house increase versus this M2 increase is not in balance, right, then the housing price will keep on increase because the house is like a physical assets, right? So this is also true for the businesses, and by businesses I mean the stock markets. So stock market also go up because of M2 become larger. One analogy that I would like to draw is that what happened with all these things is that when we talk about stock market, right, when we talk about S&P 500, we're talking about indexes, right? Index, you actually measure the worth of all these businesses using the money base, right, by dollars. The problem now is that the money base become a lot larger. It's almost like I take a ruler to measure something, but the ruler becomes shorter and shorter. So if the ruler suddenly shrink, right, becomes shorter and shorter, even let's say if I measure my height now, it's like, let's say 170 cm, right? Let's say as the ruler becomes shorter, next year I'm going to measure my height, suddenly I'm become 180 cm already. Then the year after I become 190 cm because the ruler becomes shorter. This is the problem with the measurement using dollar, because the dollar is not a fixed quantity, right? The dollars actually increase over time. So as long as you hold some physical assets, something that is like not in nominal terms, right, then I think you are fine. That's why for those who invest in, let's say like stock market, you invest in property over the long period of times, you are fine. But if you hold your wealth in, let's say like cash, in bonds, right, bonds is just nominal returns, right? Let's say if all these assets continue to inflate, all these dollars continue to inflate, right, if what you hold is just bonds, actually you will suffer a lot from the inflations. By inflation I mean the asset inflations. So this is definitely something to pay attention to, because based on what we are seeing now, based on the US government spending, this M2 it will increase. You want to have majority of your wealth not tied up in something that is tagged to nominals, stuff like US dollar. Whenever you have your money in cash, even in CPF, you are running the risk of all these inflations. So this is something to pay attention to. And this one, if you talk about like US, right, you can actually see it quite clearly, right? When the US government, they spend like crazy, we all can project that this US M2 supply is going to increase. And when this M2 supply is going to increase, you can just see it from supply demand perspective, right? When something is become oversupply, their worth actually come down. So if you look at the US dollar index, right, it has performed very, very bad since beginning of this year. It's already down by almost 11%. That's why if you recall, let's say if anyone like people outside of US, right, say I'm from Singapore, I am holding Singapore dollars, right? Whenever you use your Singapore dollars to buy US assets, right, you want to consider like, okay, it is true, maybe if I just buy US stocks, stocks, right? Yes, you can get some good returns from US stocks, but US dollar is actually depreciating against Singapore dollars. So you might want to consider that depreciations in your overall return expectation. So I think this is, everything can be quite complicated, but I think this money debasement is something that you might want to pay attention to over the long term. So this chart on the right hand side, just look at the amount of debt, and these things, right? When I talk about US, it's not just about US, because US debt of course is increasing, but if you look at the developed market excluding US, they are also increasing. Even the emerging market also increasing, because I mean the truth is that US, they are the leaders when it comes to all this fiscal monetary stuff, right? Every time, even other countries, they manage their currencies against US, right? So whatever problems that I'm describing that's happening to US, actually all other countries, they are affected as well. So when this asset inflation happens, right, I believe the entire world will suffer. Yeah, I think this chart, this is maybe not really related to the money debasement, but if we just look at US interest rate, if you look at the interest rate, it's quite high, right? If you invest in US bonds, I think it's still fine, because let's say US bonds is about like 5%, and if you want to know what is the return that you are going to get from investing in US bond, right, you just look at the starting yield. That is a good starting point already, because what this chart is saying is that if you know the starting yield, right, let's say when you buy the bonds was at 4% yield, right, your subsequent 5-year returns will be very close to 4%. So what this chart is saying, you look at the R square here is 88%, right? So if you look at US bond right now is 5%, I would say that it's likely you are going to get the 5% nominal returns. The problem is that is just the nominal returns, because the inflations from now, the long-term inflation, like, could be also, let's say, 4 or 5%. If that's the case, right, your real returns is only 1%. It's actually quite low if you just invest in bonds. That's the problem of investing in bonds. You get the certainty in terms of the payout, but you don't get the certainty in terms of the real returns. So quite dangerous one, investing in bonds, quite risky. Alright, just now I said already, we'll cover other market as well, but we only cover the big one. This chart on the left hand side, you see US forward PE is at 22x, but if you look at other markets, say for example like Japan, Eurozone, emerging market, China, their forward PE is actually quite low. It's lower than 15, but historically they are also lower. I think this kind of situation where US is overvalued but the market is performing quite well as compared to the others, this is true for a while already. I think the rest of the market, some people say that they don't deserve a high valuations just because of the dynamics of the market. US is more pro corporates, right? Maybe there's some truth in it, or maybe it is not, right? Maybe the entire market might swing the other way. But it is true that if you just look at global equity earnings, right, just look at this chart here, right? India, of course, their earnings growth has been going up a lot. If you look at China since 2020, right, they experienced some sort of like a recession, and then when you look at their earnings, it's still lingering around. That it doesn't show a huge earning growth. But if you look at US, I think the earnings growth is a lot higher, and for Japan also high. Eurozone is kind of like also up, then now stagnant already. But if you look at the right hand side, the earning growth expectations, right, actually market has been expecting the earnings growth to be quite healthy. So for India, it's like 15%, for US is 14%, for the rest of the market it's about like 9 to 12%. So that's earning growth. Okay, I think this is the most important chart. But this is talking about the long-term stuff, right? Just now, the rest that I presented, those are like the current situation, right? This is like a long-term things. So if you look at the charts, right, the green is showing the stocks returns, the blue is showing the bonds returns, and the gray is showing a 60-40, right? A mix between stocks and bonds. So if you look at 1-year returns, of course, stocks returns, right, it could be negative. The range is from negative 37% to 52%. Very big range, right? Then for bonds, it's between negative 13% to positive 13%. The reasons bonds here can show negative returns is because for bonds, right, let's say, I think they are referring to something like a 10-year bond, right? So 10-year bond, there's some duration to it. As the interest rates swing, the 10-year bonds also can swing. But of course, the volatility is much lesser as compared to stocks. So pay attention to the first group, right? When you look at the 1-year returns, right, the swing for stocks is a lot higher as compared to bonds. But if you just look at the 5-year rolling, and then you move to 10-year rolling, and you move to 20-year rolling, right? All these stocks markets, 1 year is very volatile, but as you average across 5-year, 10-year, and 20-year, right, their volatility of that rolling returns, right, is actually getting a lot lower. So pay attention to the 20 years here. You look at the range of the 20-year returns, right, 6 to 18%, right? That is actually similar to bond returns between 1% to 11%. But the good thing is that the average of the stock returns is just so much higher as compared to bonds returns. So that's why I say if your focus is on like 1 year or less than 5 year, right, then maybe you might want to hold more bonds because you want the certainty of the cash flow. But if you have, let's say, like 10 years or 20 years horizon, right, you should actually hold a lot more stocks just because of the reason that I mentioned. One thing is that the historical returns just shows that their return is a lot higher. Secondly, even if you invest in fixed income, doesn't mean that it is safe, because fixed income, when you look at it from real returns perspective, right, meaning net off of inflations, actually fixed income can be quite dangerous. Yeah, that's the takeaway. And this chart is showing just that, right? Because if you invest in large cap stocks, small cap stocks, your purchasing power can be maintained. But let's say if you invest in corporate bonds or cash, actually your purchasing power will erode over time. So this is basically shows the change in the purchasing power by different asset classes. All right, I think that's all the material that I wanted to cover. If you look at the JP Morgan slides, right, I think it's almost like 100 pages. I'm just covering, it's like maybe 20 slides out of those hundreds. As you can see here, there's already tons of information which I think is quite useful. Take a look at those pages. Let's say if there's anything, you look at those pages. Let's say if you want to discuss, you can join the Telegram group, and then you can post your questions there, and then see the members, see any one of them want to discuss with you, right? So I think that's also something good avenues to learn about the markets. I will just stop here. Maybe in the coming weeks might do some Slido Q&A so that there will be more questions. Thanks for tuning in.